This refers to reorganization of the capital structure of the company. This refers to the reorganization. This refers to the reorganization of the capital structure of the company. This refers to the reorganization of the capital structure of the company, including reducing the claim, including reducing the claim for both shareholders and the debt holders, for both shareholders and debt holders, for both shareholders and debt holders. Full stop. Then right, you see that company reconstruction is necessary. Company reconstruction is necessary. Company reconstruction is necessary. Mostly when the company is facing financial difficulties. Mostly when the company is facing financial difficulties. When the company is facing financial difficulties and has been operating at losses for a long period of time, and has been operating at losses, for a long period of time, has been operating at losses for a long period of time. Full stop. Then right, we see that another paragraph. A company can be reconstructed into two ways. A company can be reconstructed. A company can be reconstructed in two ways. Semicolon. Number one, reconstruction. Then number two, we have external reconstruction. Now, those are the two types of reconstruction. But we have an internal reconstruction and an external reconstruction. Now, just to explain just the difference that for internal reconstruction, this is where the company is not liquidated. You just make the necessary capital changes without liquidating the company. So that means in this case, it's all about the debt holders and the shareholders to sacrifice their claim so that they can save the company. But for external reconstruction, now here they give up and they need to liquidate the company. This is where the company now will be transferred or be taken over by a new company. So internal reconstruction, no liquidation. The shareholders, the debt holder, they sacrifice their wealth to save the company. External reconstruction, they liquidate the company or the company being taken over by another company. Let's start with internal reconstruction. Stroke, it's also known as capital reduction scheme. Capital reduction scheme. Capital reduction scheme. This involves making the necessary capital changes. This involves making the necessary capital changes, without liquidation, making the necessary capital changes without liquidation. Full stop. It's a scheme whereby efforts are made to bail out the company. Efforts are made to bail out the company. I mean this bail, to bail out the company from loss-making state, to bail out the company from loss-making state to a profitable state, from loss-making state to a profitable state to a profitable state. Full stop. Then you like to see that. It's a scheme whereby the shareholders and the debt holders, it's a scheme whereby shareholders and debt holders sacrifice their claim. Shareholders and debt holders sacrifice their claim in order to save the company. Sacrifice their claim in order to save the company. Sacrifice their claim in order to save the company. Now let's look at situations which calls for internal reconstruction. Situations which calls for internal reconstruction. Situations which calls for internal reconstruction. Yeah, when it's necessary to do an internal reconstruction. Situation which calls for internal reconstruction. Number one, when there are huge accumulated losses, when there are huge accumulated losses, when there are huge accumulated losses, when there are huge accumulated losses. Number two, when the available capital, when the available capital is not represented, the available capital is not represented by the available tangible asset, by the available tangible asset, by the available tangible asset, by the available tangible asset. Number three, when a change is required, on the face value of the share, where the change is required on the face value of the share, where the change is required on the face value of the shares, so as to become attractive to future investors, so as to become attractive to the future investors, become attractive to the future investors, Yeah, those are some of the circumstances which calls for internal reconstruction. Good. So now let's look at accounts prepared. Accounts prepared when accounting for internal reconstruction. Accounts prepared when accounting for internal reconstruction. When accounting for internal reconstruction. Number one, capital reduction account. Capital reduction account. And number two, we have ordinary share capital account. Ordinary share capital account. Ordinary share capital account. Now, those are the two major accounts prepared when accounting for internal reconstruction. The first one is the capital reduction. So now let's be here. Now, when preparing the capital reduction account, in this case, we are saying that internal reconstruction mostly happens when the company is struggling financially. That means they have been operating at losses for a given period of time. They have been operating at losses for a given period of time. In their balance sheet, now instead of having the retained earnings, what do you expect to have? No, retained earnings is the profit for the year, which is retained. Are you together? Which is part of the reserve. But if the company has been operating at losses, do you expect to get the retained earnings? Now you get accumulated losses. Now, if the company also, they have been making losses, you are the shareholder, have you been receiving dividends? No, no profit, no dividends. But in this case, you need to restructure the company so that you put the company, you need now to sacrifice their wealth, so that you save the company from loss-making state into a profit-making state. And how do you write off the accumulated losses? You write off the accumulated losses by preparing the capital reduction account. So on the credit side of this account, you factor in what the shareholders and the debt holders are sacrificing. So don't copy. So we have the ordinary share capital sacrificed by the shareholders. Also, you have to sacrifice all the other reserves, such as share premium, also, in case you revalue the asset, because during reconstruction, the company will have to revalue the asset. In case it's a revaluation gain, the gain is part of the reserve. You also have to sacrifice that. So revaluation gain as well as other reserves. Now that's what the ordinary shareholders will sacrifice. But we're saying that in internal reconstruction, both the shareholders and the debt holder will sacrifice their wealth so as to write off the accumulated losses. So also, you'll also factor in the debt holders' sacrifice, be it the preference shareholders or the debenture holders. This amount now they need to sacrifice so that they write off the accumulated losses. So what do we credit? You see, under the reserve, you expect to have the retained earnings, but you're saying that in this case, the company had been operating at loss. So therefore, they have accumulated losses. You write off the accumulated losses. Also, when the company is struggling financially, they have to write off the goodwill. Therefore, you also debit the goodwill written off. Also, you see that you also need to revalue the asset. If you revalue at a gain, you credit. What if you revalue at a loss? If you revalue at a loss, you debit. So here you have the revaluation, the losses. And then in case you hire some experts to do this reconstruction, you have to incur some costs. You also have to pay them. So you factor in the reconstruction cost. Then the other account we prepare, you see that is the ordinary share capital. This is a normal account, ordinary share capital account. It's a normal account where this is an equity. So you start with the balance brought down on the credit side. Then what increases the ordinary share capital is in case the company issued new shares. So issue of new shares. And then what reduces the share capital mostly is when you say that shareholders, they also need to sacrifice some of their wealth. So what they sacrifice will go to the capital reduction. So capital reduction. And that's how you get the adjusted share capital. So you can show that format. Journal entries. Journal entries. Journal entries. Number one, accumulated losses, accumulated losses, accumulated losses. So what do you debit, what do you credit? You debit capital reduction account, debit capital reduction account. You credit accumulated losses account. You credit accumulated losses account. You credit accumulated losses account. Number two, goodwill written off, goodwill written off, goodwill written off. So what do you debit? You debit capital reduction account. You debit capital reduction account. You credit goodwill account, goodwill account. Number three, with increase in asset value, 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 you debit asset account, you debit asset account, you credit capital reduction account, capital reduction account, capital reduction account. Number four, with reduction in asset value, with reduction in asset value, with reduction in asset value, you debit capital reduction account, debit capital reduction account, capital reduction account, you credit asset account, credit asset account, asset account. Another one, reconstruction cost incurred, reconstruction cost incurred, construction cost incurred. You debit capital reduction account, debit capital reduction account. You credit cash stroke bank account, cash stroke bank account, cash stroke bank account. Another one, new issue of shares, new issue of shares, new issue of shares. You debit cash stroke bank account, cash stroke bank account. You credit ordinary share capital account, ordinary share capital account. You also credit share premium. So credit share premium. You also credit share premium. So now we can do an illustration. November 2015, question 2B. November 2015, question 2B. Tab Limited is a private company. 3/4 of the issued share capital of the company are held by the directors and the members of the intermediate family. The company draft statement of financial position as at that 1st of December 2014 was as follows. So we have the non-current assets, we have the intangible assets, we have the tangible assets. Current assets, we have inventory, we have trade receivables. Then we have the current liability, we have trade payable, bank loan, and overdrafts. Under the equity, we have ordinary share capital, we have share premium. Then instead of retained earnings, they have accumulated losses. Yeah, so now you can see their financial statement is not appearing because instead of having the retained earnings, they have accumulated losses. Bank loan and overdraft consist of 400 million carrying a fixed charge on the company's building and unsecured overdraft of 287. So the bank loan has a fixed charge on the company's building. What does that mean? They secured that loan using what? The building. So how much was the loan? How much was the bank loan and overdraft? Go back to the balance sheet. 687 million, right? Then you expect bank loan to be part of non-current what? Liability. It's indicated as what there? Current liability. What does it mean? Or it's a mistake? What does it mean? It's short term. It's not short term. Bank loan should be an non-current liability, right? Yeah. But in this case, they are indicated as part of current liability. What does it mean? It's due, correct. The bank loan is due either during the year or within the next one financial year. But you can see this company has been operating at losses. How do they finance this loan? Another thing, they had secured this loan using what? They are building. So what will happen? You see this company, it's there's a question on the going concern of this company, right? Yeah, so that means either the company goes or they do a reconstruction. Reconstruction, that means that they convince the shareholder. They also convince the bank. Remember, we said that internal reconstruction, it's where the shareholders, the debt holder, they sacrifice their claim so that they can save the company. Then you are told that the demand of the company product has fallen drastically in recent years owing to the importation of high quality and cheaper alternative product from Southeast Asia. The development cost appearing in the statement of financial position relates to a new product that has been perfected to a marketable stage and for which there is believed to be a strong demand. These costs have been properly capitalized in accordance with the provision of IAS 8 intangible assets. The company is in urgent need of capital. Now, where do they get the capital? Now, here you have two alternatives. You borrow. Are you together? Why would you borrow? Now, one, the bank cannot give you the loan, right? And also, when borrowing, even if you decide to go to another bank, so you need to present the most recent financial statement. But how does your financial statement look like? The balance sheet is not appearing. Another alternative, you issue new shares. But as a shareholder, can you inject more capital because you have been making losses, therefore you are not been receiving your dividends? Will you inject more capital to a company that's making losses? No. So you're told that the company is in urgent need of capital to meet the existing liability and necessary new investment in plant and working capital. A scheme of reorganization has been drawn up for consideration by shareholders and the creditor. Remember, creditor, they are part of debt holders. So now they are coming up with a scheme to try to convince the shareholders and the debt holder, that's the creditor. The terms of this scheme are as follows. Number one, the shares of 10 shillings each are to be written down to 2. That's what we call the capital reduction. The shares of 10 shillings to be written down to 2 shillings. So how much will you, the shareholder will be sacrificing per share? 8. They sacrifice 8 shillings per share. So how much is the total capital? Total capital reduced. It's 8 shillings per share. How many shares do we have? How many shares do we have? 80,000. Good. We have 80,000 shares. So the total capital to be sacrificed by the ordinary shareholder is how much? 640. So to the ordinary share capital, the balance brought down we had was 800,000. But of this 800,000, they need to sacrifice 640. So that means you debit capital reduction. They sacrifice an amount of 640. Then we see that in the capital reduction account, you credit what the shareholders and the debt holders are sacrificing. So ordinary shareholders or ordinary share capital, they have sacrificed an amount of 640. So you debit, you credit. And the major objective of sacrificing is to write off the accumulated losses so that you debit the accumulated losses. How much is the accumulated losses? Accumulated losses an amount of 230. 232. Good. So we go back to note number 1. That the shares of 10 shillings each are to be written down to 2 shillings per share. And subsequently, every 5 shares of 2 shillings each consolidated into one fully paid ordinary share of 10 shillings. Then they effected a share consolidation. That for every 5 shares, each at 2, you consolidate them into one share of how much? 10. How many shares do we have? Now we have 80,000 shares, each at 2 shillings. Now we have to consolidate. For every 5, you get? For every 5, you get 1, right? So you take 80,000 shares, you divide by 5. 80 divided by 5, that's 1/6. You get 16,000. Now, instead of having 80,000 each at 2, now you have how many shares? 16,000 shares, each at 10. That's what we mean by share consolidation, that for every 5 shares, each at 2, you consolidate them into one share of 10 shillings. Good. Number 2. The existing shareholders are subscribed for a right issue. That means you have to convince the shareholder, they inject more capital. See, that's why you're effecting a rights issue. What's the right issue? Is the issuing of the share to the existing shareholder? Yeah, you need to convince them. Eh? The existing shareholders are to subscribe for a right issue of 2 new 10 shillings ordinary share at par for every share held after the proposed reduction and consolidation. So you have to effect a rights issue. Interpretation is very important. What is the term of the right issue? Read that point again, number 2. That's enough now. So what's the right? What's the term of the right issue? For everyone you get 2, or for every 2 you get 1? Can you read again? And for every interpretation is very important. For every pay. What do you think? For every? Usisome sana, hiyo ni mara ya 7 unasoma sasa. Lydian. How do you understand? How do you understand? For every 2 you get 1. What about Caro? For every 1 you get 2.
For every share, subscribe
for 2 more. 1, 2. 1, 2. 1, 2. 10, 10, Fei. Hakuna kitu unaelewa? An. For every 2, you get 1. For everyone, you get 2. For everyone, you get 2. Valentine. For everyone, you get 2. Ruto. For every 2, you get 1. Now let's read number 2 again. Let's read the third time. The existing shareholders are to subscribe for a right issue of 2 new 10 shillings ordinary share at par for every share held. For every share held, you subscribe for 2 new shares. Not for every 2 you buy 1. It's for everyone you buy 2 new. Interpretation is very important. Okay, how many shares do we have now? 16. If for everyone you get 2, what about 16? You cross multiply. 16 times 2 get 30. That 2 shares each at 10. So how much will we raise? 320 million. So how will we affect this? So you'll debit the cash account by an amount of 320. Then we credit ordinary share capital by an amount of 320. So that means for ordinary share capital, when you have the balance brought down, we effected a rights issue. We should shares worth 320. Good. Number 3. A major supplier agreed to exchange a debt of 180 million included in the trade payable for 18 million ordinary share of shillings 10 per value. One supplier ameona how you are struggling, akaamua, let me just get some share instead of you paying cash. How many shares? 18, each at 10, so that we settle the debt of how much? 180. So that means to the ordinary share capital, the company will have to issue new shares to pay the creditor. 18 million share, each at 10, to settle a debt of how much? 180. Good. And number 4. In full satisfaction of 687 million owing to the bank agreed to accept an immediate payment of 87 million and to consolidate the balance of 600 million into a loan carrying an interest rate of 13% per annum, payable in 5 equal annual installments commencing on that 1st December 2016. Read that point again. Now, is it a good or bad idea? Is it a good or bad idea? Yeah? Hey, that's enough. Don't read again. You are computing nothing, based on what you have understood. Is it a good or bad idea? I told you advance is all about interpretation. So how much was the bank loan? 687. Now, the bank, you see, we see that also the debt holder and the shareholder, they sacrifice their wealth. This 687 million is due. But now the bank has agreed. So you have issued some shares. You pay me how much? Just pay me 87. Then the balance of 600, I give you 5 years to pay. Is it a good or bad idea? That's a very good idea. Are you together? Yes. So msi overthink sana. Number 5. The credit balance of share premium account and the accumulated losses and goodwill are considered valueless and are to be written off. The credit balance of the share premium account, you see that, why do you factor the share premium? Share premium is part of the reserves, right? Go back to your format. You say that you credit. So we have share premium. How much was the amount? It was 50. It's to be written off. What else? Also accumulated losses. To write off the accumulated losses, you debit, as well as what? Goodwill. That means the goodwill was considered valueless. It's to be written off. So goodwill written off. How much is the value of the goodwill? It was 16,000. Good. Number 6, the asset listed below are to be restated to the following amount. You also say that during reconstruction, you need to revalue your assets. Now let's go to the balance sheet. Go back to the balance sheet. How much was the planted machinery? 326. It was revalued to 125. Again, arose. We see that all evaluation losses you debit. So we have plant and machinery. Arose by how much? 201. Then we also have inventory. Let's go to the current asset. Inventory. How much was the inventory? 426 was revalued to 10. That's arose. So inventory, an amount of 216. 216. Then we have trade receivable. How much was the carrying amount? 531 was revalued to 500. Also, it's arose by how much? Receivables arose by that one. Then lastly, we had buildings. How much was the carrying amount of the building? Then was revalued to 320. That's again by how much? That's 50, right? Yeah, revaluation gain you credit building by 50. So 640, you add 100, you get 740. Can you add this? You also get 740. Yeah. So that means they are suggesting a successful reconstruction. Let's balance here 3, 4, 5. So that's 1.3. 1.3. That one will get 660. So for the ordinary share capital, the balance carried down, we have it 660. Number 7, a group of dissatisfied shareholders plan to oppose the scheme because they feel that they are born to an inordinate burden of reorganization where the bank has lost nothing. Number 8, the company has received a cash offer of 1120 million for its non-current and current assets. Required. A revised statement of financial position of TAB Limited as at 1st of January 2015 after conclusion of proposed scheme of reorganization. A revised statement of financial position. So how will be the balance sheet real quick? So TAB Limited. Statement of financial position as at 1st of January 2015. Now, this is after the proposed reconstruction. So shillings are in thousand. Now let's go to the balance sheet. Balance sheet, we have the assets. For the assets, we have non-current assets. For the non-current assets, we have development cost. That one is an intangible asset, an amount of 85. Then we have goodwill. Goodwill was considered valueless and was written off. Then we have buildings. Building was revalued, so you take the revalued amount. Note number 6 was an amount of 320. Then there was planted machinery. You also take the revalued amount, which was revalued to 125. Then we have the current assets. Now, for the current assets, we had inventory. You also take the revalued amount. Was revalued to? It was revalued to 210. Then we had trade receivables. Trade receivables revalued to an amount of 500. What else do we have? We also have cash. There was a right issue. For the right issue, we say that you debit cash by 320, you credit the ordinary share capital by 320. So 320 minus, let's go to note number 4. Note number 4. In full satisfaction of 687 million owing to the bank agrees to accept an immediate payment of 87. Yeah, of what we raised, we pay the bank 87. How much will be the balance? 2? 233. Good. Now give me the total assets. You get 1473. Equity and liability. For the equity and liability, we have the ordinary share capital. For the ordinary share capital, you take the adjusted amount, the balance carried down, which is 660. Share premium was written off. Then we have non-current liability. Did you have any non-current liability or was current liability? We go back to note number 6. Number 6, we are told that in full satisfaction of 687 million owing to the bank agreed to accept an immediate payment of 87 million and to consolidate the balance of 600 into a loan carrying an interest of 13% per annum, payable in 5 equal annual installments, payable in the next 5 years. So therefore, it becomes a long term. So 13% loan note, an amount of 600. Lastly, we have the current liabilities. To the current liabilities, we had trade payables. Trade payable was an amount of 393 minus, let's go to note number 3. Number 3, I told that a major supplier agreed to exchange a debt of 180, including the trade payable for 18 million ordinary share. Now, this 389, one of the creditor, we gave him shares worth 180. So how much is the balance to? Give me the total equity and liabilities. Get 1470. Good. That's how it will look like. Now let's go to note number 7. Note number 7. Note number 7. In note number 7, you are told that a group of dissatisfied shareholders plan to oppose the scheme. You see, for this scheme, they need a special resolution. So that means not all will be convinced about this scheme, because assuming you are one of the shareholders, imagine your share being slashed from 10 to 2. Will you accept? It will depend whether you are risk taker or risk cover. But why are they opposing? If they're opposing, that means there is an alternative. Let's go to note number 8. The company has received a cash offer of 1120 million. That's 1.12 billion for its non-current and current. Yeah, there is another company who want to acquire this company. That's what we call a takeover. And they'll pay how much? 1120. So that's why we have a group of dissatisfied shareholders who want to oppose this scheme. So the other alternative is to do what? Yeah, they sell, they just share the money. Now let's go to required number 2. Required number 2. A report to the group of dissatisfied shareholders advising on whether they should accept or reject the scheme of the organization. We need now to advise them. If we reconstruct, this is what will happen. If they sell, this is what will happen. What happens during liquidation? Selling is all about liquidating the company, right? How much will they fetch? They'll get 1120 million. Remember, our shillings are in thousands. Now, the rules of reconstruction or liquidation is that once you sell an asset, the liquidator will give the first priority to the debt holders. First of all, you pay all the debt. What remains is what you will share among the shareholders. Now, if they have to receive this amount, first of all, they pay the debt. Now, let's go to the liabilities. They had various debt. Number 1, they had to trade payables, an amount of 393. Also, they pay the bank an amount of 687. How much remained for them to share? 40. Now you want to get the amount per share, because how they share, it depends with the number of share you had. So it's 40 million. How many shares did they have? 80,000, right? So that means for every share, how much did you get? 0.5 shillings. Now, can you advise them? Should they sell or should they reconstruct? to reconstruct. See, at least after reconstruction, at least you have 2 shillings, eh? And also you mean to be the shareholder. Good. So they should reconstruct the company. So you can copy now. May 2018. Question 2B. The foreign statement of financial position related to the affairs of Fanakawa Limited as at that 1st of December 2017. So we have the non-current assets, we have landed building, plant and machinery. Intangible assets, we have goodwill, we have development expenditure. Current asset, we have inventory, we have receivables. Under equity and liabilities, we have ordinary share capital, share premium, accumulated losses, shareholders fund. Then current liabilities, we have trade payables, bank overdraft, bank loan secured on landed building, and then we have total equity and liabilities. Additional information. Fanakawa Limited has been making losses in recent years, but recent board changes and the development of a new product line are believed to have significantly improved the company's future prospects. The following scheme of financial reorganization has been prepared for consideration by shareholders and the creditors. Number one, the existing ordinary shares are to be written down to 4. Capital reduction. Now, how much is the par value? It's 10 shillings to be written down to 4 shillings. So there is a loss by how much? 6. So total capital reduced 6 shillings per share. How many shares do we have? 6,000, eh? 600. So they sacrifice an amount of how much? 36. So to the ordinary share capital, we had the balance brought down, which was an amount of 6,000. Of the 6,000, they sacrificed 3.6. So that one goes to the capital reduction, an amount of 36. You debit, you credit the capital reduction account. Show that the ordinary shareholders, they have sacrificed an amount of 3.6 so as to write off the accumulated losses. So you debit the accumulated losses. How much is the accumulated losses? 2070. Good. And so I told that we are number one, that the existing ordinary shares are to be written down to 4 per share and then consolidated into shares of 10. So how many shares do we have? Can you do that? Share consolidation. How many shares will we have? Should be done by now. That you just divide by 10. So I want individual answers now. Mkisikia individual answer mnasoma tena. Faith, how many shares? $1,800. Valentine. Han, how many shares are you getting? Walter. How many shares are you getting? 360. Rusi, how many shares are you getting? Nothing. Lydian, what are you getting? 360. Si umesoma sana. Nini mnasoma? Si swali imesema and subsequently they were consolidated into shares of 10. That's all, nothing more. Even if you read again, you not get a clue. You know, you're overthinking something which is very simple. Brayo, 300. What are you getting? Sorry? 360. Umesoma sana. Na sikusoma nasoma. How many shares? 360?
Yeah.
300. That's why I like different answers. What are you getting? 360. Sorry? You are getting 1800. That's what I want, the difference. Faith, what are you getting? Sorry? 1500. Let me see what the honor students are getting. 1080, 360, 240, 60, 240. Na sasa nyinyi wote, you have one teacher. Do you see how these things are hard? Yeah, when you're doing by yourself. So in case you ever get a refer, don't ever blame the teacher or blame the examiner. Jiblame wewe mwenyewe. Why? You see, you are getting different answers, right? But you have the same teacher. Are you getting? So that means when I'm trying to interpret, it becomes easier for you. But when you interpret for yourself, it becomes hard. That's what happened in an exam. You'll find that the paper was very simple. Hii swali tulifanya na John Mark kwa class, waliniangusha. You are given your paper, the rumors you wrote. Because all the answer you're getting different answers. How are you getting different answers? So that means 90% are wrong. Because they are, you know, in mathematics, this is not like theory. In theory, you can use your own language. In mathematics, the number does not rhyme. If it's 240, it's 240. It cannot be 241. That's interpretation. Let's read number 1 again. The existing ordinary shares are to be written down to 4 and then consolidated into shares of 10. How many shares do we have? We have 600 shares, each at. We have already consolidated. We did consolidation first, right? So you have 600 shares now at 4. So how much is the remaining share capital? 6 times 4, you get how much? 24. Then this 24 was consolidated into shares of 10. Of the 2400, if we consolidate them each year at 10, how many shares will we have? Just divide by 10. You get 240 shares, each at 10. Number 2. The existing shareholders. Now, note that if you are wrong here, even number 2, number 3, number 4, number 5, you'll still be wrong. Yes. The existing shareholders are subscribed for a right issue of 3 new shares for every 1 share held after making the changes in 1 above. The shares were issued at 11. So they effected a rights issue. How much? What was the term? For every? For everyone you buy 3 new shares. How many shares do we have? 240. That's why I'm saying that if you got anything, if you got, I didn't get 240, that means also this one will be wrong. That means it will affect the share capital, will affect the capital reduction account. So for everyone, you get 3. What about 240? 240 times 3, you get 700 and how much was the issue price? 11. 7,200, you add 720, you get 7920. So how will you account for this? You'll debit cash account with an amount of 7920. Then you credit ordinary share with an amount of how much? 7,200. Then you grade it, share premium. Now, ordinary share capital are recognized at par value. How much is the par value? 10. But how much was the issue price? 11. So to the ordinary share capital, you take 720 shares. You show them, you recognize them at par value, which was 10. But the issue price was not 10. It was at 11. So that means there was a premium of 1 shillings per share. So 720 of the 11, you minus 10, the premium was 1. So you get an amount of 720. So that means to the ordinary share capital account, we effected a rights issue. Then you show an amount of 72, not 79. Then this 720, it will take it to the share premium account. Good. Number 3, the company major supplier has agreed to convert an amount of 1 million owed to him into fully paid ordinary share issued at par. Yes, we decided to pay the creditor. And we gave him share was worth how much? Read number 3 again. Then number 4, the bank requires immediate payment of the overdraft, but has agreed to convert the loan currently payable on demand into a debenture carrying an interest of 10% per annum payable in full in the next 5 years. Now, can we go back to the current liability? Go back to the current liabilities. And the current liability, we have a bank overdraft of 1,100. Then we had bank loan secured on land and building. As you can see, it's part of current liability. So that means the amount is due. Then we are told that number 4, the bank requires immediate payment of the overdraft, but has agreed to convert the loan currently payable on demand into a debenture carrying an interest of 10% per annum payable in full in the next 5 years. So there was an extension for 5 years. Number 5, the balance in the accumulated losses, goodwill account are to be written off. Accumulated losses, also the goodwill are to be written off. So goodwill written off. How much was the value of the goodwill? Is it 1,300? Yes, it was an amount of 1,300. Number 6, development expenditure is to be written off. Also, we write off the development expenditure. An amount of 750. Number 7, the remaining assets are to be restated at their fair values as follows. Land and building. Now let's go to the carrying amount. How much was the carrying amount of land and building? That 160 was evaluated to that 320. That's an increase by 160, right? Yeah, revaluation gain, we see that you credited. So there was a revaluation gain of land and building. Land and building again by 160. Then you have planted machinery. How much was the carrying amount? 40 was revalued to 1,000. Aroused by how much? Plant and machinery. Amount of 30-40. Then you also had inventories. How much was the carrying amount? Was revalued to 15. Aroused by how much? Yes, aroused by 400. Then we have trade receivable. How much was the carrying amount? Was revalued to 17. So there was no gain or loss. Number 8, the amount in the share premium account is to be utilized in capital reduction scheme. But share premium is part of the equity which the shareholders are sacrificing. So there is share premium, an amount of, yeah, it was an amount of 2,000. So now let's balance this. This side is more, eh? How much do you get? 75.60. 75.60. So how much is the balancing figure? 1,800. Now, what is this 1,800? Now this 1800, the balancing figure to the capital reduction is known as the capital reserve. Now the capital reserve can either be on the credit side or the debit side. Now this is what I mean. The debit side is more than the credit side. What we have in the credit side is what the shareholders are sacrificing so that they can write off this amount. So what happened? What they were supposed to write off was more than what they sacrificed. They sacrificed. And there was a deficit by how much? 18. So now, after reconstruction also, they also need to sacrifice an additional how much? 18. In case what they sacrificed was more than this, that one adds their equity reserve. So you'll add it. But in this case, you'll have to deduct the value of their capital because they have to sacrifice an additional 18. What about this? 14,200 minus 36? That is 10,600. So that's our balance carried down. Required? Journal entries to record the above transaction. Journal entry. What are journal entries? T accounts, apana. T account, the ledger accounts. Journal is all about debiting and crediting. Journal entries. I'd given you the some journal entries, what to debit, what to credit. So what do you debit? What do you credit? But you don't have to cram that. So now let's be here. So let's work with the start with the capital reduction account. Number one, we have accumulated losses account. What are the journal entries to this? Don't look what you have in your notes. Everything is there. You debit. Good. You see this amount of 2070. You have debited the capital reduction account. So you'll debit the capital reduction account with an amount of 20. You credit which is which account? Good. Accumulated losses account. With the same amount of 2070. You also have goodwill written off, so you debit the capital reduction account with an amount of 1,300. You credit the goodwill account. 1,300. And then you have development expenditure. You debit the capital reduction account with an amount of 750. You credit the development expenditure account. 750. We also have planted machinery. That was a revaluation loss. You debit the capital reduction account with an amount of 3040. You credit the specific asset or PPE account. So plant and machinery account with an amount of 3040. We also have inventory. You debit the capital reduction account 400. You credit inventory account. Inventory account 400. Credit side. We have ordinary share capital. What are the journal entries to that? Yeah, you always start with what you're debiting. You debit? Sorry? Good. This that 600 you had debited the ordinary share capital account? Yeah, ordinary share capital account with an amount of 36, and then you credited the capital reduction account. Land and building was a revaluation gain. Again, we increase the value of the asset, and for the asset you debit. So you debit land and building with an amount of 160. You credit capital reduction account 160. What about share premium? You debit the share premium account with an amount of 2,000. You credit capital reduction account with an amount of 2,000. Then there was issue of shares. Or before we go to the issue of shares, we have this. What are the journal entries to this? The credit an amount of 1,000. What are journal entries? Nimunipe jibu mwache kukula mdomo. You debit which account? Ordinary. You debit creditors account with an amount of, then you see, which account have you created this amount of 1,000? You had created ordinary share capital account? Good. Ordinary share capital account with an amount of 1,000. Also, there was issue of share, of which you debited the cash account, cash stroke bank account with an amount of 79.20. Then you credited the ordinary share capital with this an amount of 7,200, as well as there was share premium, an amount of 720. Required number 2. So number 1 was the journal entries to record the above transaction. Number 2 was the capital reduction account. How do you prepare capital reduction account? How do you prepare? It's already there, number 3, statement of financial position after effecting the scheme of reorganization. Now, how is the balance sheet look like? So this was Fanakawa Limited. Statement of financial position as at January 1st, 2018. We start with the assets, non-current assets. Let's go to the balance sheet. So we have rendered building. You take the revalued amount. It was revalued to 30. Yeah, it was valued to that 320. Then there was planted machinery, an amount of 1,000. Now, for the intangible asset, goodwill was written off. Development expenditure was also written off. So we go to the current assets. The current assets, we have inventories. You take the revalued amount. Inventory was valued to 1,500. Receivables was revalued to 17. Then we have cash at bank. We effected a rights issue, an amount of 79.20. Then we paid the bank OD. Let's go to note number 4. Note number 4. The bank requires immediate payment of overdraft, but have agreed to convert their own current payable on demand into debenture carrying an interest of 10% per annum payable in the next 5 years. So how much was the bank OD? Was it 1,100? So how much will be balance? 68? Give me the total assets. Sorry? 14. Then we have equity and liabilities. For the equity and liabilities, we have ordinary share capital. Ordinary share capital. Here we have the ordinary share capital. Yeah, you take 10,600. Then there is capital reserve. An amount of 18. You see that capital reserve can be on the debit side or the credit. We say that they need to sacrifice an additional 18. To sacrifice, you raise. Because on the debit side, you do what? You add. Good. Then accumulate share premium. Also, we have share premium. An amount of? It was an amount of? Good. 720. The 2,000 was utilized in capital reduction. But through the rights issue, we issued at a premium of 720. Good. Non-current liability. What do you have to the non-current liability? Can you go back to number 4? The bank requires immediate payment of the overdraft, but has agreed to convert their own currently payable in demand into a debenture carrying an interest of 10%. So we have a 10% debenture. And now it's no longer our own. It has been converted to a debenture. So that means for the debenture, they are given an opportunity to only be paying an interest of 10, 10, 10, 10. Upon maturity, that's when you pay the full amount. So how much was that amount? 4,000. Then we have the current liabilities. To the current liability, we have trade payable. Trade payables was an amount of 18, 20. Yeah, but there's one creditor who gave shares, right? That was note number 3. The company major supplier has agreed to convert an amount of 1 million shillings owed to him into fully paid ordinary share. Where's 1 million? What do you get? 820. Give me that. 14,340. So you can copy now. Go and try this question. May 2019, question 3B. I wish to call it a day. So that was all about the internal reconstruction. So we still have an external reconstruction.